From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Wednesday the 20th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day stateside. Quiet trading session, you could argue, with some exciting things happening. From London, I'm Guy Johnson. Alix Steel is in New York. Welcome, everybody, to Bloomberg Markets. Alix, as I say, on the surface, it doesn't look that exciting. Stocks, though, inching back towards records. Bitcoin's already there.
Yeah, Bitcoin's already there. Also, for S&P, for example, we're now the sixth day on the upside. We haven't seen that kind of winning streak since all the way back in July. For here, it's hard to find a real driver of what's leading it. Sure, you get some earnings. We'll get to that in just a second. You get a lot of healthcare names. They're all the outperformers within the S&P, but the S&P up by 0.2%. But as you pointed out, Bitcoin up a whopping 3%, yet another record. You had that first Bitcoin futures ETF, second day of trading, up about 5%. That really helping that kind of outperformance. The curve steeper, so that's going to be better for banks, etc. But not a lot of movement in the bond market. Again, it feels like it's much more over in your neck of the woods with a lot of buying coming in to the gilt market. Now, volatility, though, climbing down quite a bit, which is so interesting because PIMCO, and you heard Joachim Fels just talking about this, there's more uncertainty, there's more uneven growth, sentiment's rolling over, but there's TINA, there's no alternative. Therefore, buying stocks, therefore, volatility in the equity market continues to come down, Guy.
Absolutely. I think it was John Authers talking about TINA Plus in his piece this morning.
I love that one.
It is basically being pushed pretty hard. Yeah, I must read every morning. Let's dig in. Let's get to our top stories and kind of get a little bit more detail as to what is happening here. Bloomberg's Abigail Doolittle has the latest on the earnings stories that we're watching. The virus is back. It's part of the conversation again. Bloomberg opinion columnist Max Neeson looking at New York City's plan to mandate COVID-19 vaccinations for all city workers. The testing option no longer there. Bloomberg's Anne-Marie Hordern on details on the Democrats starting to make some progress. Baby steps towards progress on the president's infrastructure deal. So we're going to watch all of that. Netflix, certainly one of the movers that we're watching so carefully here with the earnings season in kind of full-throated roar now, and it's having an impact on the market. Abigail Doolittle, what are the details? Well, Guy,
Netflix is certainly having an impact on the market, but well off of its lows and really a relatively small move. So Netflix right now down 1.7%. They, of course, beat adjusted earnings estimates. Sales coming in right online, so still the pandemic, coming out of the pandemic malaise, weighing on Netflix to some degree. Subscribers really not as strong as expected. Deutsche Bank cutting shares on the fact that they're saying that valuation is very high and all the good stuff is priced in. But prior to the report, the options market had pointed to an 8% move up or down. We're simply not seeing that kind of volatility. Let's see how it plays out. United Airlines had been down more. They, of course, posted a narrower loss than expected. CEO Scott Kirby has voiced concerns, though, about rising jet fuel costs. On those concerns, the stock had been down, but it looks like we may see that one flip higher. Speaking of higher, Alex, let's take a look at a number of the healthcare stocks, because here is the good on the day for earnings season. You can see big gains here right across the board. Anthem up nearly 6%, an intraday record high. You and Guy talking about those record highs. There is one they beat, and they also boosted the full year outlook. Biogen up 1.8%. They also put up a solid quarter despite the fact, and they boosted their outlook despite the fact that the uptake for their Alzheimer's drug a little bit slower than maybe had been hoped for. And then finally, Abbott Labs up 3.6%. They beat, and a lot of it, Alex, and they also boosted, and then a lot of it, Alex, has to do, of course, with COVID testing and strong demand there.
Yeah, those stocks really roaring higher here. Roar, Guy, my daughter's favorite song right now. All right, Bloomberg's Abigail Doolittle. Thanks so much for joining us. All right, here in New York City, got all city workers are now required to be vaccinated. Employees not vaccinated by next Friday will be placed on unpaid leave. That says we're getting closer to the Moderna booster. Maybe those 40 and over will get boosters, while cases, though, rising in Europe. Max Neeson, Bloomberg opinion columnist, has the details. Max, it's been a while since we've had you at the top of the show. What is the state of play of COVID?
Ever evolving and very complicated. Speaking first about the New York mandate, just a sort of ongoing movement towards more stringent and broader vaccine mandates, in this case, eliminating a testing exemption, something that makes sense because, first of all, frequent testing is very expensive, and opening that up as an alternative isn't really as effective in either protecting people or workplaces as mandating vaccines. And then these upticks you're seeing, in the UK, also Singapore, that's unfortunately sort of the reality we're going to be living in heading into the winter season. As long as you don't have universal vaccination, you have vaccine efficacy fading in some people. You have very different levels of kind of non-pharmaceutical intervention around the world. You're going to see these rolling outbreaks. But the good news is that over time, fewer and fewer infections are going to lead to hospitalization or death due to both vaccination levels and prior immunity. So you will still see these ongoing outbreaks, but over time they will get less severe.
Yep, the Health Secretary here in the UK is going to be briefing in a couple of hours. We'll see exactly what he has to say in terms of the progress or direction we are going to take. Max Neeson, thank you very much indeed. Max Neeson, Bloomberg opinion columnist on the healthcare story. You don't often get to say these days that we're seeing progress in DC, but maybe we actually are seeing some right now. Democrats making headway in breaking their stalemate on President Biden's economic agenda. They're getting rid of or trimming parts of the multi-trillion-dollar spending package that was originally proposed. Here to talk about some of the concessions that are being made, Bloomberg Washington correspondent Anne-Marie Hordern on Capitol Hill. AMH.
Guys, certainly they are trimming, and potentially if they drill it down to $1.75 trillion, that would cut in half that ambitious $3.5 trillion package. But there is momentum, and what you can see coming out of these meetings yesterday at the White House, the president meeting both wings of the party, the progressives and the centrists, is that you could see what is going to be ditched and what potentially will live, and what might live, just not to its full extent. So what do I mean? So the child tax credit, that will likely get a single-year renewal. The hope was that would go to 2025. So you can see how they already are seeing some concessions that are being made from the left to meet the centrists on the right. Also, things like the community college provision, that's completely getting ditched. And then there are question marks, like the clean electricity program. If Senator Manchin maintains that he cannot vote for that, that is something that is still ongoing discussion. How do you fill that hole? Potentially a carbon tax, potentially more tax relief for renewable companies. We need to see what they come up with. But you can start to see a bit of a framework, of a blueprint of where the concessions are being made. And this is really what the president is trying to do, really try to bridge both wings of his party to be able to make it tolerable for those moderates, but at the same time, not lose those crucial progressive votes.
Yeah, as time's ticking there. All right, Anne-Marie, thanks a lot. Bloomberg's Anne-Marie Hordern joining us on that. All right, coming up, you got stocks inching towards those record highs. You got strong earnings, yet overall uneven inflation, uneven growth, lots of concerns and sentiment. How do we square those two? Anastasia Amoroso is going to help us. iCapital Network Chief Investment Strategist will be joining us next. This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. All right, you got fears of stagflation. They may be easing. You got the Treasury curve steepening for a second day. Former Goldman Sachs CEO Lloyd Blankfein spoke exclusively to Bloomberg's Eric Schatzker on the challenge of raising interest rates.
Some things that are inevitable that I'd be so concerned is how we manage interest rates going back to what I'll call normal, but normal by history. If everybody owns paper that has been issued at 0.5%, 1%, 2%, and interest rates go to 10-year interest rates go to 5%, not an unreasonable place for them to be if you look at over history. What happens to the mark-to-market on everybody's portfolio in the world, any instrument ever issued that's still extant? As a result of low interest rates, people have been taking extra credit risk, maybe sovereign risk, but extra credit risk in order to get higher yields. That will break people's hearts because things are stable, but if the market gets disrupted, it tends to be the weaker credits that separate the stronger credits separate from the weaker. So there's a number of things that can go wrong when money starts to get allocated by assigning a cost to money that's more consistent with history. And that's a long way from where we are now in the market.
Are we or are we about to have an inflation problem?
There's a lot of remedies in the world, painful as they are, for inflation. It's very hard to get rid of deflation. So if you had to err on one side or another, you would err on allowing a certain amount of inflation to take place and not want to get yourself into a kind of deflationary. See Japan for 25 years as a reference.
Lloyd Blankfein, former Goldman Sachs chairman and CEO, of course, speaking exclusively to Bloomberg's Eric Schatzker on Bloomberg Front Row. Let's talk more about some of the things that he just talked about there. Anastasia Amoroso, ICAP Network Chief Investment Strategist, joining us now. Lloyd Blankfein thinks it's not unreasonable for interest rates to go to 5%. If interest rates go to 5%, how different does the strategy need to be?
Well, if we were to go to 5%, the strategy would be very different. And as Lloyd said, every single asset class around the world would need to be repriced. So if we were to go to that level, that obviously poses a big risk to valuations from anything in public markets, private markets, and so forth. But I think Lloyd would also agree that this is not the scenario that we foresee in the near-term future. I think the likely scenario is that inflation is going to stay elevated. We're still going to be running core PCE close to 4% for the next few quarters. And slowly but surely, we're likely to come down to 3%, 2.5% by the tail end of next year. So the Fed may or may not act on that, but they're not going to act by hiking, multiple times in a quarter. They're likely to go at a very measured pace. So I think that's a scenario that we can put aside for the time being. The scenario that we need to focus on today is how are we going to overcome these inflation challenges and how are we going to overcome the supply chain issues so that profitability remains intact for corporations and purchasing power remains intact for consumers as well.
100%. And that's literally all we're listening for on all the calls. Where do you think that that's priced in, and where do you think there's more potential downside to be priced in dealing with that?
Alex, I think a lot of the supply chain fears are starting to be priced in. I mean, I really see Q3 as the quarter for peak shortages and peak delays. And we even had, I think General Motors reported the other day saying that they likely have seen some of those peak disruptions in Q3, and things are likely to improve for auto production, for example, in Q4 and into 2022. So I think we are largely pricing that in. And there's three different indicators that I would point to say that maybe a lot of these things are priced in. First of all, it's the shipping costs that a lot of companies have worried about. And if you look at some of the shipping indices, the price for container ship freight has started to come down. It's still very high historically speaking, but it has started to come back down because we're not seeing just as many delays off the ports of LA, for example. And we are starting to get some of the port backers back to work. We're starting to see improvement in trucking employment as well. And so that should alleviate the bottlenecks in the trucking sector. And then the last factor that I would point to, the reason why there's also the manufacturing intermediary goods shortages, that has to do with factory closures in Asia, which were very draconian and very strict. And I think those will begin to abate too as the cases abate.
Just seen Singapore going back into lockdown, so it's not going to be a straight road. Anastasia, my takeaway from the earnings season thus far is that the consumer's going to pay, not the corporation, i.e. we are going to see prices being ultimately passed on. Yeah. Do I avoid anything with consumer exposure?
I think it's a little bit challenging for consumer industries. So the good news is that corporations are raising prices to make up for higher input costs, and so they are largely preserving the margin. So I think that's a really good thing for the earnings season. The other piece of good news, I would say, that they're also raising wages, and wages, as we know, are running 4.6% year over year. So consumers are actually able to buy those goods that are now more expensive. So those are really two positive things. But I would still, from an investment perspective, shy away from consumer staples and consumer discretionary, because at some point after 3 price hikes, do you go for that 4th? I'm not so sure. And at the same time, even though I do think we're seeing peak shortages that should abate, it's still going to take months or maybe quarters for them to fully resolve. And by the way, some of the consumer companies are using contract rates versus spot rates. So I still think because they have thin margins, those margins can still be under pressure and be compressed. So I would avoid some of those sectors. And I would focus on sectors like real estate, financials, parts of infotech, where margins are really wide. and you don't have the same sensitivity to rising labor costs, for example.
Here's my broader question, and I kind of was hinting at that before. Do markets care? And I made this point earlier when you have, PIMCO coming out and saying we have an uneven recovery, uneven growth, et cetera. Sentiment is rolling over for all the reasons that you just outlined. Risks are piling up on that. But the VIX is at 15, and we're still right around record highs for the S&P.
Yeah, there's a few reasons why the markets are shaking off a lot of this. I would say seasonality just has a lot to do with it. I mean, year after year, we see the same pattern. We have a volatile September, the volatile first half of October, and then things tend to pick up. I think the reason, Alex, this happens is because a lot of concerns get built up in September. And this year's case in point, we had the debt ceiling, the different fiscal worries, we had the supply chain, and then you tend to resolve a lot of those concerns as you approach year end. And I think that's what the markets are going through today, is this a little bit of positive resolution. The other thing too is there's a lot of concerns that are being raised and are being thrown at these corporates, but take a look at the earnings numbers. First of all, we have, I think, a 13% earnings surprise so far this quarter. And now the growth rate for Q3 has been not ratcheted up to 30%. That's not something to sneeze at. That's a very positive number. And the margins are 12.5%. So I think that's why there's a tendency to shake some of these fears off. And if I look into 2022, earnings growth is still likely to be 9%. So all in, this is a positive backdrop for markets.
65,920, the current price of Bitcoin. Buyer or seller?
All right. It is a little bit difficult to make a short-term call on Bitcoin here, because I will say we've seen a tremendous rally and, we're looking at some levels that are overbought. But for a lot of our clients, actually, I think for a lot of holders of Bitcoin, this is a longer-term allocation they hold and they stick to it as part of their strategy. So I would think about buying it on any dips that we get, because longer term, if you think about, there's close to 40 million of Bitcoin addresses today. If that 40 million goes to 80 million and something higher than that, that network value, that network effect of Bitcoin should continue to drive the price of it higher. So I think it's an important part of the portfolio. It has the low correlation. It has a high risk adjusted expected return as well as, prior return. So I think it does have a place in the portfolio, but it's been quite a rally here near term.
That was a yes, but maybe not today. Anastasia Amoroso, iCapital Network Chief Investment Strategist, thank you very, very much. And let's talk more about supply chains. You're going to tune in tomorrow for a special edition of Bloomberg Markets, The Close and What'd You Miss, focusing on supply chain pain. You got Caroline Hyde from Bostic will be live from the second busiest container port in the United States, the Port of Long Beach. So don't miss that. It starts at 2 p.m. Tomorrow in New York. All right, coming up right now on this program, you got 2 out of 3 Netflix subscribers now have seen the Korean hit series about people deep in debt playing children's games with a deadly penalty if you lose. Squid Game drives Netflix to its best subscriber growth of the year. Is that sustainable? That's next. This is Bloomberg.
What we saw as the quarter continued it into September, we saw acceleration in our growth, which is what we had been hoping for and expecting, but it was good to see as we got into the strength of our schedule.
Netflix CFO Spencer Newman talking on the analyst call yesterday. Netflix subscriber growth doubled from last year. Tepid fourth quarter outlook, maybe leaving people a bit concerned, which is why stocks may be drifting a little lower today. I appreciate they're off their lows. Dave Wilson breaking down the figures.
Well, Guy, I mean, when you talk about, a bit of disappointment with the fourth quarter outlook, we should point out Netflix looking for 8.5 million new subscribers to be added in the quarter. And analysts were pretty much right around there, about 8.4 million on average in a Bloomberg survey. But their earnings forecast for the quarter came up short. And there's an issue with what you would call free cash flow. And so we'll come back to that in a moment. But just looking at subscribers, you can see, there was that pandemic-driven burst last year in terms of people willing to sign up for the service and pay for it because they were spending so much time at home. That's faded this year. Now it's coming back. So, that's a plus. Clearly, the popularity of Squid Game has been a part of that. But beyond that, you look at actually Google search figures and you see that indeed there were more done in the early fourth quarter than there were in the third quarter. So there is the potential for Squid Game to help in the current 3-month period as well. But the free cash flow issue is definitely out there. That's money that Netflix can use to repay debt, to make new programs, that sort of thing. Analysts were looking for it to be positive in the third quarter, and it was negative, so you had a cash outflow. And on top of that, Netflix is talking about it being negative this quarter as well, though they're anticipating that once you get to next year and beyond, it becomes positive.
Well, so Dave, how much of that can we attribute, the decline today, attribute to things like what you're talking about versus a pure, buy the rumor, sell the news? And Netflix was already trading so well.
Well, there's no doubt on the latter point, Alex. I mean, you only have to go back about 2 weeks to see a record for the stock. And, to put it in perspective, it's only down maybe 3% or so since then. You can argue that what we're seeing today is a case of selling on the news. You can also argue that there's enough things to be disappointed about given the performance of Netflix shares over time, that if you're looking for weak spots in the quarterly results or in the outlook, you found them when it came to things like the earnings forecast and cash flow.
All right, Dave, thanks a lot. Really appreciate it. Bloomberg's Dave Wilson joining us there. I just want to break some news for you here. Majority Leader Chuck Schumer is speaking right now on the Senate floor. So some headlines here. He's going to speak with Nancy Pelosi and the White House later today. And he's calling for the fact that everyone must compromise to reach an economic agenda deal. But he does say that they're getting closer to an agreement and that Democrats are united in the desire to reach a deal this week. Guy, I got to wonder if he's speaking for everybody there or just if hopes are spring eternal or dreams spring eternal at the end of the day.
Yeah, United Democrats doesn't feel like something that we've really experienced recently, does it? Apparently salt's still on the table as well, which unsurprisingly is certainly one of the top red stories that we're watching here on the Bloomberg. Everybody firmly focused on that, I would imagine, including you.
Absolutely. Deducting those state and local taxes for property. We all really care about that here. All right, coming up on the program, we're going to talk more about what I also care about, which is commodity prices. You're getting a little bit of a dip today. Part of that is an inventory issue. Part of that is China coming into the market and trying to suppress some of their energy prices. We're going to speak to Ed Morse, Citi Global Head of Commodities Research. He'll be joining us next. This is Bloomberg.
Approaching half past the hour, live from London. I'm Guy Johnson, Alix Steel, of course, over in New York. This is Bloomberg Markets. Alex, it wasn't that long ago, in reality, that we were worried about oil storage. We were worried about inventories. We were worried that we couldn't get any more oil into storage because, basically, there wasn't any storage left. That situation is reversing and reversing rapidly.
Yes. I'm like, which period of history are you talking about? I feel like there's been so many times we've been worried that there haven't been enough storage. But now the question becomes, where are we in terms of production and in terms of storage here in the U.S. for natural gas as well as oil? We're getting the latest oil read right now. Inventories actually saw a little bit of a draw there rather than a build of 431,000. Cushing also saw a very big draw of 2.3 million. Gasoline inventories saw a draw. Distillate inventories saw a draw. Refinery utilization was down by about 2%. So we're slowly drawing out of storage on the crude oil supply as well as the product supply as well. How this sets us up, though, for a cold winter, that's really then the question. Joining us to help us answer all of this question as we wind up having oil still over 80 is Ed Morse, Citi Global Head of Commodities Research. Ed, you heard me say that we saw a draw across the board from Cushing overall inventories as well as distillate and gasoline inventories. What's the state of play supply and demand-wise here in the U.S.?
It's very, very tight. We're having inventories pulling down to lower and lower levels. And it's not just in the U.S., but it's across everything we can observe in the world of inventories. And you mentioned the weather. The numbers we like to look at is days of forward coverage of inventory. We're kind of at the margin below a healthy side. Healthy would be above 55 days of forward coverage. You get to 60 and over, that's where we were I'll remind you, it was April of last year that we ran out of storage and oil prices went negative. No place to put it. But this time we're worried with a cold winter that days of forward demand cover could, for the OECD as a whole and for observable inventory, get down to 50 days. That's almost unheard of. So it's the exact reverse of 14 months ago or 15 months ago.
Ed, you guys are fine over there. You guys are an energy island. It's the rest of us that are having problems. What do you think the outlook's going to be here in Europe and in Asia?
You're absolutely right, Guy. I mean, we are an island. We are mostly self-sufficient. We're absolutely self-sufficient in natural gas. So while our prices went down a little bit below $5 per million MBTU, you get to spot prices of LNG in Asia. It's been hovering around $33, $35, and the same price level in the heart of Europe. TTF is about the same as JKM in the Asian sphere, and your NBP prices are way up there too. So yes, it is a very tough entry to winter for most of the rest of the world.
Well, we'll get to that in just point again in just a second. I just want to go back to Guy's point. He always says this to me: you guys are fine. You're an island. You're going to be energy independent. You have all this oil and natural gas, but we're not actually producing it. So why do you think that price signal is so broken?
Well, it's partly broken. It's not fully broken. It's the discipline of the publicly traded companies. The privately owned companies are really ramping up their drilling activity, and we're seeing it. I don't know what the production number was from the EIA today. If you tell me what it was, I can comment on it. But you know, we're getting the return of everything shut down in Hurricane Ida, and we're well above the low point. So I think we're about to see a year ahead, which is going to look more like 2019 than 2020 or 2021. We're going to see order of magnitude 1,300,000 or 400,000 barrels a day of U.S. production growth, if you include NGLs, the liquids that get produced along with natural gas, along with crude oil. So I think the drilling has kept up enough, and I think it's going to continue to increase at a rate, and we'll soon see the public companies adding to what we've already seen in the privates.
Well, Guy, let me just jump in, because production was actually just 100,000 barrels a day short of the high that we saw before in Hurricane Ida. So to Ed's point, Guy, yes, we are producing more oil here.
And the Permian is just about as what its former peak was.
True.
Yeah. So back to my point, you guys are fine. We over here, less so. Ed, what does the worst case scenario look like in Europe this winter?
The worst case scenario for Europe, and we've had like a half a dozen of these in the last 30 years, if we have weather like we've had a half a dozen times in the last 30 years, Europe will run out of natural gas available in inventory. And God knows what the price means, because it means you've got to hit a price that really rations consumption to get the market even. So double or triple today's prices is well within the realm of reality. So yeah, $100 natural gas and the electricity equivalent of it if weather is really, really cold.
Okay, so let's just actually point this out. We stole this chart from your most recent note, Ed, and it shows the different drawdowns in inventory in Europe for natural gas based on how cold it's going to be. And this is the scenario you're talking about, which is we're assuming a really cold winter of 2005, 2006. You're looking at below 0 BCM storage. That means your inventory is depleted completely. But in a better case scenario, we're still relatively depleted here. So I'm just wondering how quickly you think that Europe can stock up if, say, we have the average of the last 4 years.
Well, the question is, where is the inventory going to come from? We know that the main source of supply is no longer LNG. All of the LNG that's available in the world has been taken up, and the Chinese have gone into a bidding war with whatever available extra barrels, extra molecules there might be. So nothing is going to come in by the way of LNG. A little bit maybe if hydro turns in Brazil and the U.S. LNG going to Brazil today switches to Europe, that could happen. But we're not talking about a lot of natural gas that way. And so far, the Russians have been facing the same problem everyone else. Low inventories because of the high temperatures in the summertime. So they couldn't produce enough to fill up their own inventory, let alone Europe's inventory. And the Russians say sometime in November, is that November 1st or November 30th, that the Russian supplies are going to get flowing again back into Europe. And that will make a huge difference. But like the weather, we don't know what the Russian supply is going to be. Maybe
it's just next November, not the one coming, the one after that. What can China do? This is a key question. China is trying to manage the markets, trying to basically change the landscape. It is focusing on coal. It is trying to manage the price there. How in control do you think the Chinese authorities can be of their own destiny when it comes to energy prices this winter?
Well, here's the rub, Guy. They can be in pretty decent control. They can, as they have already, either rationed or cut off electricity to certain industries that are heavily energy intensive. And yes, you're looking at our chart of where coal inventories in China were at the beginning of winter. So what they can do is really hurt the economy. They can subsidize industry to shut down, pay the workers. But the shutting in of industry, energy-intensive industry, that's aluminum, copper, zinc, other things like that, cement that are impacted by it. And that means lower rate of growth. Our own economists have already dropped our expectations of Chinese growth for this quarter by 0.5%, down to 4.5%. They may have to double down on that depending on what's going to happen in terms of industrial availability of electricity over the wintertime in China.
So Ed, before we let you go, I have to ask about the copper market because it does also feed into the China story. We've seen record backwardation on the LME. We've seen record stock draws. Trafigura had to drain a lot in order to meet client demand. This is intensely unusual. Do you think that what we're seeing here with copper is an idiosyncratic thing, or do you think that this is what we're going to start to continually see as we go through this green energy transition?
Copper is a particular problem in that we don't know where the supply is going to come from. The supply that we can identify is much more expensive than the average supply of copper. So whatever happens in the near term, yes, rising prices right now, probably dropping by the time we get to the end of winter. But the issue with copper is that the incremental molecule that's of demand goes into a greener planet. It's more than half of our expected copper demand, which will be incremental to today's demand, is based on greening of the world. And copper is really a part of that for the time being. So copper prices will go up again. Yes.
Copper prices will go up again. Ed, great to see you. Stay warm. Thank you very much indeed. Ed Morse of Citi. Greatly appreciated. What are we going to talk about next? Bitcoin. That's quite energy consumptive, isn't it? Bitcoin rallying to a record high. This after the strong debut of the first US ETF investing in Bitcoin futures. We'll talk more about this next. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, live in the principal room. Coming up, Scott Kirby, United Airlines CEO. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News now. I'm John Hyland. Twitter CEO Jack Dorsey tweeted out the number 705742 yesterday afternoon, leaving some trying to guess whether it's related to digital currencies. Dorsey frequently tweets about the crypto market, and Twitter announced in September that it would let users send and receive tips using Bitcoin. Bitcoin rose to a record high today after a strong debut by the first U.S. exchange-traded fund investing in Bitcoin futures, stoked optimism. And investors may have traded a lot of the new Bitcoin futures ETF on its first day, but crypto bull Cathie Wood was not among them. Here's Wood at the Milken Institute Global Conference on her reasoning.
We're looking at this very carefully, the futures. There are some tax ramifications we'd like to understand more, having to do with contango, which is what contango versus more normal backwardation.
Right.
So
not yet.
We're not yet.
The fund from ProShares is based on Bitcoin futures and is the first of its kind in the U.S. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm John Hyland. This is Bloomberg. Guy?
John, thank you very much indeed. Let's stick with that Bitcoin theme. Record highs today, at one point up over 3%. This, of course, after the launch yesterday of that ProShares Bitcoin ETF, started trading, surged more than 120% this year. The Bitcoin story. Goldman Sachs was the first US bank to enter the crypto business under then Lloyd Blankfein. He spoke about why they got into this early. He talked to Bloomberg's Eric Schatzker in that front row interview.
A lot of bright people think it has a bright future. I'm telling you, I have I have whole foot and 4 toes into the old world, and it's not something that I gravitate to, and I can think of a lot of reasons why it won't work. But I remember when they were auctioning off spectrum for cell phones, and say, well, why would anyone need a cell phone? All you do is you pull up to, you drive in your car, pull up to a phone booth, and dial a phone. Who would carry that clunky thing? And, the point is, there are a lot of things in this world that have worked out awfully well.
You sound, for somebody who used to run a bank, pretty constructive about crypto.
I'm open to it. Look, I ran a bank, I ran risk. And you can't be closed. You have to separate fact from opinion. Nobody knows, nobody knows the future. I mean, there's all sorts of things. There's a lot of things that move in directions that I couldn't and wouldn't have anticipated, and no one else would have either. So to just come out and say that a market that's already in excess of $2 trillion, that faces all these regulatory headwinds, that a lot of people really don't like and would enjoy seeing crushed, somehow managed, it doesn't, every day it doesn't look like it's flourishing, but on no day has it recently looked like it's dying.
Do you own any? Do you own any crypto?
No.
So one of his toes does not own crypto. You can see the rest of that great interview with Lloyd Blankfein, the former chairman and CEO of Goldman Sachs, and Bloomberg's Eric Schatzker, all on your terminals. Definitely go check it out. Let's get more to the ProShares Bitcoin Strategy ETF BITO, second highest traded fund ever. More than 24 million shares traded hands yesterday in its market debut. Katie Greifeld, Bloomberg cross-asset reporter, joins us now. Okay, so really successful launch. Now what?
Now what? I mean, looking at the trading today, it looks like it's still in high demand, even after that huge demand that we saw yesterday. Just under $1 billion worth of BITO traded yesterday. In the first 15 minutes today, you saw over 200 million traded. So it's going to be fascinating to see where that number ends up. But also today, you have options available on this ETF on NYSE. And it's going to be interesting to see how that shakes out, because that should be pretty meaningful for retail investors as well as institutional traders, being able to either hedge their positions on the ETF or being able actually to maybe supercharge some of those bets. So just fascinating watching this in real time.
Katie, what's the chat about this? What are people saying? It was interesting to listen to Cathie Wood talk about sort of contangos and backwardation. I think that was where she was going. But the concern here is that obviously if you roll forward, you've got to pay a higher price, and ultimately that's going to eat into returns. Is this something, therefore, that is going to end up with a fairly limited audience, because most people will suddenly realize that ultimately they are having to basically give some of their returns away and therefore return to the kind of the physical market, if you can have a physical Bitcoin? Or do you think this is going to become something that, as you say, a wide spectrum of people ultimately use and suck up that cost?
Well, Guy, that was the expectation, that actually you weren't going to see people rushing for this ETF because it is futures-based. And this is something we deal with all the time when we talk about commodity ETFs, oil ETFs in particular, that they have to deal with those contango costs, the cost of rolling forward those contracts. That eats into returns. But just looking at the trading in the past 24 hours, clearly that doesn't seem to be a concern for some of the investors going into this fund. We know that's a concern for the issuers, Cathie Wood, for example. We also know that Invesco, in particular, dropped their pursuit of their futures Bitcoin ETF. They didn't say why, but they said that they're still going to pursue a physically backed ETF. So it's definitely something that the issuers are thinking about. Little surprised to see that investors are still really going for this.
Katie, great stuff. It's amazing to see this thing still going day two. Such a strong response. Katie Greifeld, great stuff. We're getting some headlines coming out of Germany. Unsurprisingly, I think, Angela Merkel is indicating that she's going to leave the succession planning, Alex, for Jens Weidmann, who announced that he was going to be stepping down early as head of the Bundesbank, to her successor, which looks like her current finance minister, Olaf Scholz, will ultimately have to make that decision. It does seem as if everybody was surprised that Jens Weidmann is stepping down, but it does seem as if this is now becoming maybe the way that Bundesbank heads leave. They don't go on time. We've seen time after time that they've decided to leave. Still don't know exactly why he's going, but he says personal reasons.
They always say personal reasons.
Exactly. But I think it'll be interesting to find out ultimately why. He was, of course, passed over in the race to become the next president of the ECB. Christine Lagarde getting that job.
Passing that buck, though.
Yeah, haven't seen a German yet taking that role. What are we going to talk about next? One of Europe's largest private equity firms getting bigger. We're going to hear from Christian Sinding. He is the CEO of the largest listed publicly traded private equity firm in Europe, EQT. Looking forward to hearing about that. This is Bloomberg.
European private equity firm EQT is shifting focus to target long-term investments in companies they expect to shape the future. Christian Sinding, EQT CEO and managing partner, spoke to Bloomberg's Ed Hammond.
Well, what's different about it is that, EQT as a firm, we actually want to have a positive impact with everything that we do. So when we thought about, how do we sharpen our pencil and have even more impact than we are already today, we said, well, we want to have a fund which is really differentiated. And the two things we felt were kind of missing in the market was, one, to be able to really invest for the long term, to drive long-term positive transformation. And the other is a bigger fund that also links real impact targets to the fund's performance and also to the fund's compensation. So we're calling this an impact-led strategy. It's going to have, instead of a lifetime of 10 years, which is typical in private equity, it's going to have a 15-year life. And the average investment holding period will be 8 to 10 years instead of 3 to 4 or 5 years. So it enables us to have a slightly different mindset and think even more about driving, the kind of transformation that's needed now to make both the environment and society, better over time.
And the deal-making environment in PE right now is, much like the rest of all M&A, is extraordinarily high valuations. You're seeing companies often compete in fairly heavy bidding wars. I wonder how a firm like EQT retains its discipline and also manages to deploy capital, because those two things seem to have a lot of tension right now.
Yeah, it's an excellent question. And what we've been building since 1994 is really trying to focus on thematic investments, as we call it. So we're trying to find companies and industries that are backed by long-term secular trends. And then we try to find businesses where the price that we pay for the company today is not really the determining factor for the return of the investment over time. So companies where we can really drive innovation, drive internationalization, do add-on acquisitions, maybe take real transformational leaps like a company I mentioned actually earlier today on our quarterly earnings call, which is the largest yellow bus school company in the world, obviously located in the United States, where today all those buses are diesel driven, and our investment thesis is to actually transform those buses to electrical vehicles, making them more future-proofed, more environmentally friendly, and also safer. So trying to find companies like that where the price we pay today, even if that's a full price, we can still make a very attractive return by driving that kind of transformation.
Interesting stuff. An impact at a grassroots level. Christian Sinding, EQT CEO and managing partner, speaking, of course, to Bloomberg's Ed Hammond. That is where I think we're going to see a lot of the effects coming through. If you can get granular, you can get down to some of these obvious levels. Alex, you kind of walk around and you can just see opportunity after opportunity. He talks about yellow buses. That seems like such an obvious thing to do. Kids going to school, there are thousands of them. If you can transform those buses, make an impact there, that's going to have a huge effect.
I just think that there's just so much money, much cash waiting to be deployed. And let's not forget SPACs. There's billions of money in SPACs that have to be spent over the next couple years as well. So there's a lot of stuff happening, and I just wonder what's the valuation for a lot of these guys too? Like how much more are they going to have to pay up, and will have to continue to pay up, even though they say they want to get the good value, just to get something on the books.
Yeah, what kind of IRR are these guys going to be kicking out in some of this stuff? I think is going to be interesting. Are you as an investor going to be best served? I appreciate that we have to have a conscience, but are you going to be best served from a returns point of view by going into this space. A lot of people are very confident, but as you say, there's an awful lot of money floating around at the moment. Okay, what do we need to talk about next? We need to talk about what's happening in the European markets. We are seeing a subdued session thus far. The earnings story, the dominant narrative. Inflation front and center. That's next. This is Bloomberg.